You've got a chunk of cash to put to work, an inheritance, a bonus, money from selling something, and you're stuck on one question: is now a good time? The market feels high, and there is always a reason it feels like the worst possible moment to jump in. The valuations, the headlines, whatever everyone's afraid of this week. So the money just sits, waiting for a green light that never quite turns green. One quick thing. So this actually applies to you. This is about having a lump sum sitting there. If you're just investing a slice of every paycheck, relax. There's no decision to agonize over. You're already spreading it out automatically. So before you decide, meet this man. He had the worst investing timing in recorded history. Over 40 years, he put money into the market exactly 4 times. And every single time, he managed to do it at the worst possible moment. Right at the top, right before a crash. You could not be this unlucky on purpose if you tried. And he still retired a millionaire. By the end of this, you'll see why the question you're asking is the wrong one, and why the thing keeping you up at night barely moves your outcome at all. That man isn't someone I invented. He's a now famous example built by a finance writer named Ben Carlson, who called him Bob, and every crash, every number in Bob's story is real market history. And Bob is about the most ordinary saver you can imagine. He started in the early 1970s, putting away $2,000 a year, bumping it up as his paycheck grew. $4,000 in the 80s, $6,000 in the 90s, $8,000 in the 2000s. The problem wasn't how much he saved. It was when he finally hit buy. Because Bob only ever invested at the top. He'd let his cash pile up for years, working up the courage, and then put the whole lot in at the exact worst moment. He dropped $46,000 into the market in the summer of 1987. Weeks later, Black Monday. He put in another $68,000 at the end of 1999, right before the dot-com crash cut the market nearly in half. Then $64,000 more in October 2007, staring straight into the 2008 collapse. 4 times he invested. 4 times he watched it crater, sometimes by half, almost immediately. All in, he put $184,000 into the market, every dollar at the worst possible time, and he retired with $1.1 million. So how does the worst timing on record still end in a fortune? Bob did exactly one thing right. Through every one of those crashes, he never sold a single share. He just left it alone. That's Carlson's whole point. The buying was a catastrophe, and it barely mattered. Fine, terrible timing survives, but surely perfect timing wins big. A data analyst named Nick Maggiulli tested exactly that, across decades of real market history. Picture an investor with godlike power. He doesn't guess, he knows. Every crash, before it happens, he sees the exact bottom coming, sits patiently in cash, and buys at the precise lowest point, every single time. 1932, 1974, 2009. He nails every generational bottom perfectly, with the benefit of hindsight no human will ever have. Against him, an investor who just puts in the same amount every month, buying blindly, never looking at a chart. Perfect timing against no timing at all. And the title of Maggiulli's analysis gives away the ending. Even God couldn't beat dollar cost averaging. About 70% of the time, the blind monthly investor won. How is that possible? Because while God sat in cash waiting for his perfect crash, the other guy's money was already in the market, earning dividends, compounding, growing for years. And most of the perfect bottoms God was holding out for simply never came. The market just kept climbing without him. His idle cash bled him dry while he waited to be brilliant. And here's the number that should end the argument. If God is off by just 2 months, misses the exact bottom by a hair, his odds of winning collapsed from about 30% to 3. Timing so good it's literally divine, and it's still lost to a guy who just showed up every month. So look at what these two prove, side by side. The worst timing in history still made Bob a millionaire. Perfect, godlike timing still lost to a guy who wasn't even trying. Which means the exact when you're agonizing over is a rounding error. But don't take my word for it. Let me just show you the numbers. Charles Schwab ran this test. 5 people, each investing $2,000 a year for 20 years. The first has perfect timing. Every year she buys on the single best day, the exact low. The second doesn't think at all. She just invests the moment she has the cash. The third does the worst thing possible. Every year she buys on the exact high. And the last one does what you might be tempted to do right now. He keeps his cash safe, waiting for a good time that never quite feels right. 20 years later, perfect timing finished with $186,000. The worst timing on record? $151,000. So the entire lifetime value of godlike timing, best case versus worst case, is about $35,000. Now, the woman who just invested immediately with zero skill and zero stress. $170,000, practically neck and neck with God. And the man who sat in cash, waiting for his moment, $47,000. He didn't give up $35,000. He gave up over $100,000, 3 times the cost of the worst timing imaginable. The penalty for waiting dwarfs the prize for timing. So here is the whole game, and it comes down to 2 things. Neither of them is when you buy. First, how much you put in, and how long it sits there compounding. That's not a small lever, it's the whole machine. Remember Bob? With the worst timing alive, he ended with $1.1 million. If he'd simply invested his savings as he earned them, instead of hoarding cash waiting for the right moment, he'd have had $2.3 million. More than double, not from better timing, but from more time. Second, whether you've got the nerve to leave it alone. That's it. Time in the market, not timing the market. Now the exact thought that's probably running through your head. But the market's at an all-time high. I'll just wait for it to drop. And I want to be fair to it. This is the most reasonable sounding mistake in all of investing. Buying at the very top feels obviously dangerous. So let's not argue about how it feels. Let's check it against the data. Since 1950, the market has closed at a fresh all-time high on about 1 out of every 14 trading days. Record highs aren't a warning light. They're just what a rising market looks like. And if you had only ever invested on those scary record high days, over the next year, your money did about as well as investing on any random day. By J.P. Morgan's numbers, actually a hair better. 9.6% versus 9.4%. A market at an all-time high is not a market about to fall. Most of the time it's just a market doing what markets do. Climbing, setting a record, then setting another. The dip you're waiting for is usually just the market leaving without you. As Peter Lynch put it, far more money has been lost by investors preparing for corrections than has been lost in the corrections themselves. Here's the honest pushback in 2 parts. Does timing matter at all? A little. If you've got a lump sum, putting it all in at once does beat trickling it in slowly, about 2/3 of the time. For the same boring reason, more time in the market. But that's a small edge next to the 2 things that actually decide it. And there's a catch that Bob's never sold was quietly leaning on. 2 of them, really. First, Bob's market came back. Every single time. That's held for the US historically, but it is not a law of nature. In 1989, Japan's stock market hit an all-time high, and then didn't reach it again for 34 years. Someone who bought that peak waited more than 3 decades just to break even. Never sell only works if you're holding something broad enough to recover, which is the real reason to own the whole world instead of betting on one country. Second, Bob had the nerve to sit through 4 crashes without flinching. If you're the kind of person who'll panic and bail the first time your account drops 30%, no clever entry point can save you, because your problem was never when you got in. It's whether you can stay in when it hurts. And that one is big enough for its own episode. So stop asking, is now a good time? Is the wrong question. Nearly impossible to answer. And as Bob just showed you, almost beside the point. Ask the 2 that actually matter instead. 1. Can I put the money in? 2. Can I promise myself I won't yank it back out when it drops? Get those 2 right, and you could have the single worst timing in the history of the world, and still retire a millionaire. Time in the market beats timing the market. So stop timing and start counting the years. This is education, not advice. I don't know your situation, and nothing here is a recommendation for you.